This is the first full week of 2026 for the markets. Last week we saw holiday, we saw light volumes. We did see a lot of sector movement. We'll take a look and see what to expect coming up in the early January. See if we can pick up some signals from last week. We are entering into the new year, and a lot of people are wondering what's around the corner when we open the door for 2026. Is it going to be different than last year? I think so. It's going to be dramatically different. And let's try and follow along and see what's developing as far as, what took place last week and what to expect this week coming up. So let's jump right in. A quick synopsis of last year, what took place in the markets for total return for the S&P 500 sectors. Here, the black line here, this line right here, is the S&P 500, and you can see the winning sectors were the technology sector here in gold, the communication sector here, and the industrial sector as well. So two growth sectors. What I do want to point out, though, is if you take a look here, we can see that the technology sector was coming down quite a bit. And that's one of the factors we're going to have to look at coming into 2026. Is the relative performance of the technology sector still going to continue lower compared to the S&P 500? And we're going to see rotation into other parts of the market. Is that going to take place? If we take a look at the other sectors here, generally speaking, it was some of the defensive sectors that were down here. And the worst performing sector was the real estate sector in the U.S. This is the daily performance last week for the S&P 500. And if we take a look at these days here, we had Monday was negative, Tuesday was negative, Wednesday was a big negative, Thursday was a holiday, and we did see the markets rise on Friday, but overall the S&P 500 was down for the week. If we take a look here, we can see the S&P 500 was down 1% for the week. The big winner last week was the energy sector. Now this is a really interesting sector to take a look at. We're going to take a look at what happened to West Texas Intermediate over 2025, and in the context of what's taking place right now geopolitically with Venezuela again. But we've seen the energy sector do quite well overall. Last week we did see the utility sector positive as well. The biggest loser here was the consumer discretionary sector. Amazon and Tesla are the two biggest components of this sector on a cap-weighted basis, and they about 20% each. And if we take a look here, both have not been performing well, so we saw the discretionary sector down a fair bit. Technology underperformed the S&P 500 as well last week. Let's take a look at the Canadian energy sector. So we're going to use the ETF XEG in the U.S. This is the same type of phenomenon here taking place. So this line right here in red. So the Canadian energy sector has been doing well since April. But look at the price of oil in the U.S. Look at this. It has been heading lower in this time period. So we have, once again, this K-shaped phenomenon taking place. And there's all sorts of talks about a huge amount of extra oil floating around the world, etc. And the price of oil keeps going down, and the energy stocks keep moving higher. A couple things on that. First of all, I think also we're starting to see an overall broad switch into the commodity sector. We're starting to see pickups across the board in this, and the energy sector stocks are looking further ahead. Now, this K-shaped economy or K-shaped phenomenon taking place in the oil sector has happened quite a few times in the past. It does get resolved, and the big question is does the energy sector, does the price of oil start to head higher? Now, I'm filming this on Saturday morning, January the 3rd, and we've got an announcement saying that the U.S. has, quote unquote, captured the president of Venezuela. And they have plans, fairly obviously, around the energy sector, and I think some around the mineral sector as well. And I'm not going to get into the geopolitics or even the politics of it so much, but if the U.S. was to start to take oil from Venezuela, that could have an impact on Canada. A couple things going on here. First of all, Venezuela produces about 1 million barrels of oil a day. 80% of that goes to China. So when they're actually taking oil from the oil tankers, they're actually taking Chinese oil. I'm sure China is not happy about that. And I think we're going to see more and more of this restrictions on commodities. On January 1st, we saw this restriction from China implementing, saying that anybody exporting silver needs to have an export approval. And we've seen this with the rare earth elements in 2025. We saw that with silver, and we'll have to see how China deals with this. Now, if we take a look at what the impact on Canada could be, if the U.S. was able to actually redirect that oil to the Gulf Coast, and their refineries on the Gulf Coast are actually set up to handle heavy oil, which is basically the Canadian oil that's being exported. So Canada produces about 5 million barrels a day and exports about 4 million down to the U.S. a day. Now, there's a big, huge differential between the price of oil on the world market for West Texas versus the Western Canadian Select. It's cheaper just because Canada is landlocked, and if we can't get the oil to the coast, the U.S. says, well, we'll just take it at a cheaper price. It's also more expensive to produce, to refine as well. But this could have an impact on Canada further down the road. So 1 million barrels of oil a day right now for Venezuela. They could actually increase if the U.S. did go in and grab the oil production. They could increase it over the next year or so to 2 million, and longer term probably to 4 million, 5 million barrels a day. So that could have an impact on Canada longer term. We'll have to see what happens and how this is being perceived and how fast they move and in which direction they're going, etc. But it is an interesting development. So I did think I'd talk about that today. I expect to see some volatility in the energy sector in Canada and the U.S., both of which have been performing relatively well given the price of oil declining. If we take a look at some of the other markets, just for reference here, once again, S&P 500 down 1%, small caps down about the same. So small caps, we're going to take a look at the fund flow for small caps in a minute and what's taking place there. But typically at this time of the year, small caps tend to perform well. The Canadian market was flat. China was actually up 2.1%. If we take a look at some of the select subsectors here, we can see uranium, or I should say natural gas, down 6%. Now, and I've written about this in my books in the past, natural gas tends to perform well from early September into mid-December, so December the 20th. And at the end of the year, natural gas really tends to get sold off. In fact, it's the worst time of the year for natural gas. And the reason being is the refineries actually get taxed on their inventory in the south of the United States, so they tend to dump natural gas into the market at lower prices, and it has an impact on the natural gas price. Last week, we did see semiconductors pick up here, 2%. I find that interesting given the weakness in the technology sector. We'll have to see how that plays out here. The big story last week was what was happening in the precious metals market. We saw silver down almost 8%, gold miners down 6%, and gold down over 4%. In 2025, all three of these sectors did extremely well. So sometimes it's expected that you could see some volatility coming to the new year where investors are saying, well, I'm going to sell this off. It's gone too high. Structurally, there are some longer-term supports for the price to move higher for all three of these sectors. What was interesting last week, though, was, before I say that, I want to say all three of these have just started their strong seasonal period, which really is in January. It goes into February and can go into March as well. So January tends to be a good month for all three of these sectors here. Silver is the big story of what's taking place right now. Up a huge amount, over 150% last year, and a lot of volatility taking place last week. And let's talk about that. Here's the daily price for silver on Monday last week. The new margin requirements, increased margin requirements from the CME group, the COMEX increase in margin requirements because of volatility with silver. So a lot of forced sellers that were extended out on their margins. So we saw silver have quite a drop here. And these movements, especially in if you start to compare in the overnight markets, sometimes there's like a 12 to 14% differential between the high and the low, including the overnight markets. Just absolutely huge. This is so unusual to see this. And then on Tuesday, we saw the silver rebound again, go up and then actually close at this level here. And then the COMEX came along again and raised margin requirements again. And then we saw silver actually head lower. Look at that. Look at the lack of volatility for one day here. Went down quite a bit though. on Wednesday, and then on Friday we did see silver go up high here again, and a little bit of a lack of volatility compared to what we saw earlier in the week here. So this is quite the story. We're seeing a lot of retail interest in the East, in Asia, around silver, where they're really buying this at a frantic rate, both on actual physical silver consumers and also in ETFs. And we're seeing a pickup here in ETFs purchasing silver as well, where investors are starting to get interested in silver. And that's really been pushing the price higher for silver. And we're seeing a lot of transshipments around the world for silver back and forth to try and cover what's going on. But it has overall pushed the price up higher. Now, longer term, and I've done some videos. I did a video on this just recently about the structural demand for silver. It's actually been in a deficit for the last 5 years. So we've seen this with copper, we've seen this with uranium. We know there's going to be a deficit in the future. And at some point, the deficits catch up. And this 2026 might be the year for silver. We'll have to see how it goes, but it has been volatile right here. But we do have at least a seasonal tailwind helping us at this point. Okay, and here are the Canadian sectors last week in the performance. The energy sector, once again, was the strong performer. Technology was the weak performer. At the beginning of the year, investors are looking for clues to what might unfold. Is there any rotation taking place on sectors that were not loved last year that are all of a sudden getting a little bit of love? Or where's the money starting to flow? It's a hard game to try and figure out, because a lot of it's done by retail because of with a lack of volume. With institution, you'll find a lot of the big traders are committing positions. But sometimes you want to take a look and say, well, where are the clues here, and can we see a hold here? Now, in this case, I've come up with some sectors here, and I just want to focus on the last day here, and a little bit of a spike. I know I've gone all the way back here and shown you the performance all the way back, just so you can get an overall picture. Here's uranium. We did see uranium on Friday actually pop up quite a bit. Now, the chart on uranium right now is not that constructive. We are seeing this downtrend taking place. We'll have to see if that continues on. Here we are in aerospace and defense. Actually, this is actually looking very positive. Here we saw that spike up, the same phenomenon taking place as well. And if we go down to here, we can take a look at steel. Steel actually has done extremely well over the year. And we saw that spike as well. And if we take a look at metals and mining, just like steel, we saw that do extremely well. We saw that pull back. Some of the metals and mining sector, we would have gold and silver in here as well. It has done it well, and we saw that spike here a little bit. Now, I want to say, generally speaking, some of these sectors like metals and mining tends to have a weaker seasonal period in the first part of January and a lot of volatility, and then it tends to do well later on. So what we saw was in this risk-off move last week wasn't really a rush into technology. Actually, the first day of the year in the morning, we saw a lot of the hot traders pile into technology, but then that just faded, and we saw the rotation taking place into more of the cyclical and commodity sectors of the market. So that's something we're going to have to watch out for to see if this is going to be a persistent trend in 2026. I think we might see more rotation broadening out of the market into some of these sectors overall. And what we should do really is combine the seasonality with that phenomenon taking place. This is the fund flows for the ETF XME in the US, the metals and mining sector. And if you can take a look here, we can actually see that we actually saw the metals and mining flows into the ETF net flows actually decrease quite a bit recently here, which is typically not a good sign, but it is the year end, so it's hard to measure exactly what's going on. And if we take a look here at the previous year end, we can see here that we did go up and did pop down here a little bit. Nothing like what we've seen as far as the movement here, but it is something to watch out for, the fact that we did see that net outflow for XME taking place. So that pop up on the last day, of last week that took place. And we'll have to see that if that is going to be persistent. Fund flows out does not support that we'll see that sector move up. Now, there's a lot of moving pieces taking place here, but this is something to watch out for. This is the XLV, the healthcare sector in the US, and this is an important one to follow because on a seasonal basis, the healthcare sector tends to perform well in the month of January. Now, November was also a seasonally strong month, and it performed well in that time period. It's pulled back since, but this could be an attractive sector. If we take a look here at net fund flows, we can see here we're down to this base level here, where we have seen fund flows leave the sector in December, basically, and we're back down to this level here. If we start to see an uptick, it could be a positive sign, and we are in that strong seasonal period. This isn't a bad sector as far as the diversification goes. If investors are going to start to back off into defensives, the healthcare sector tends to be stronger than, let's say, consumer staples. If we take a look at the performance relative to the S&P 500, here's November. Look at that. A really strong performance when it has a strong seasonal period in November. Pull back in December. December tends not to be a strong seasonal period for the healthcare sector, and overall, we're down here, and we're really in a consolidation pattern. And on an absolute basis for XLB, we're also in a consolidation pattern. So overall, this sector looks attractive from a fund flows perspective, especially if we start to see that turn around. And because we've reached the bottom here, where it starts to turn around typically, or at least has historically. And if we start to see that take place, the healthcare sector once again could do well in a strong seasonal period in January. Here's the small cap sector. I'm using IWM for the ETF flows here. You can see it has pulled back here, and the sector has underperformed the S&P 500. We see a lot of movement. We're not down at the bottom here yet. This is quite an interesting sector. Technically, seasonally tends to be strong at this time of the year. In my Thackeray's January 2026 newsletter that's coming out this week, I will be talking about the small cap sector, and there are some concerning issues if we start to take a look at some of the other metrics. So I encourage you to actually read the newsletter. I also talk about it in the video that I do of the newsletter, but definitely consider subscribing to the newsletter on alphamountain.com because I will get into the small cap sector here. But you can see here we're not there yet, so it's really a neutral signal here because you only want to take a look when it gets to the lower or upper bounds. And we take a look, we have seen the small cap sector underperform here and also on an absolute basis as well. But once again, it could start to pick up some of this if we start to see the rotation in the markets from other sectors in the market. January tends to be a stronger month and into February. So this may change. We'll have to see what happens. But right now, we really are neutral from a fund flow perspective. And we're not seeing anything really technically strong at this time. So what should we expect in the markets this week coming up? Well, this is the first full week for the markets. This is where it gets busy. We see the institutional players really trying to come back and position their different preferences in a portfolio, et cetera. Retail becomes less of a dominant factor. Volumes pick up. So it's going to be an interesting week. In the U.S., as far as economic data, we see a huge raft of data coming out this week as well. It could really move markets around. It's going to be interesting to see how the market reacts to that. In Canada, we do see, if we start off with Canada, we do see the unemployment report coming out. If we take a look at net change of employment here, now, in the previous month, we saw an increase of 53,600 jobs increase. And this time around, we're expecting a loss of 7,500 jobs. And I got to tell you, I saw some political figures running around saying, look how strong Canada is, or look how many jobs we've created, and look how unemployment has gone down, et cetera, et cetera. Canada's data is lumpy, and you really have to really take a look at the overall trend. In 2025, Canada was quite anemic as far as its actual GDP, real GDP, especially when you factor out the government spending, which really is not a big, huge long-term contributor to GDP. If we take a look at the unemployment rate, in the previous month, we saw the unemployment rate dropped to 6.5%. Now, before that, it had been 6.9%. So that was a big drop. Once again, really lumpy data. That was probably not going to hold. That was a big anomaly to see that much of a drop taking place. It's expected to actually increase to 6.7% this time around. I would not be surprised to see the unemployment rate pick up in Canada, at least in the second half of the year. And perhaps we see 7.5 or something up around that region heading higher. I don't think the trend is lower at this point for Canada. If we take a look at the last unemployment report, We can see here that, yes, we did see 53,600 jobs created, but 63,000 part-time jobs. This is not a sign of a strong economy when people have to take part-time jobs just to pay their bills, is really what's taking place here. Full-time jobs created was down 9.4 thousand. Okay, if we take a look at the U.S. here, we can see that the ISM prices, manufacturing prices coming out this week. So 48.4, a little bit of a tick up high here. Still in contraction mode. So it's been the services that have really been helping the U.S. economy. So, but still a little bit higher than the previous. If we go down here and take a look, this is what everybody's going to be looking here. The PCE price index year over year came in at 2.8%. Right now, there's not any expectations, but this is going to be the number that really influences the market on Monday. Because we saw that CPI number for inflation come in lower than expected. And if there's a confirmation from the PCE, the narrative's really going to shift that inflation is under control. And there's going to be a lot of pressure on the Federal Reserve to continue to cut rates, etc. So that really could be a market mover. If we take a look at the non-farm payroll numbers expected to come out on Friday, previously it was 64,000. It's expected to come in at 55,000 here at this level here. The unemployment rate is expected to actually head lower from 4.6 to 4.5%. So yes, the non-farm payroll number could also be the mover at the end of the week. So right now it's a barbell as far as economic strategy goes. There's lots of other data. I'm not going to go through all the other data coming out during the week, but it's really on Monday when we take a look at the PCE inflation report, core inflation report, and then on Friday we see the non-farm payroll number. This is going to be a busy week for the markets, and it's going to be an interesting one to follow. I'm particularly going to be watching where the money flows, where investors are actually putting their money. Are we seeing a broadening away? Really, it's we saw technology sector do well in 2025, but in the last quarter, the technology sector really underperformed the market, the S&P 500, as the narrative started to shift. We got through this before. Is there enough power? Are there enough data centers? Now there's financing trouble and a whole bunch of stuff here. And so investors still want to be invested in the markets at this point. And the next stage might be moving money into other sectors, whether it's commodity-based or cyclical-based. I think we could see a pickup on that. So I'm going to be watching for that. If the money really shifts on a wholesale basis, into the defensive sectors, now healthcare could do well because it is a strong seasonal period for healthcare. But if we see that big shift beyond what would be anything normal, that could indicate that yes, investors are still are interested in being invested in the markets, but they're really getting defensive here, and that would not be good. I'm not convinced that's going to happen at this level. I think we're probably going to see more of a shift from the growth sectors into some of the cyclical sectors, and into some of the commodity sectors as well. So it's going to be an interesting one to follow, and I'm going to try and follow that over time and overlay some of these fund flows with seasonals as well to really pick up a more dynamic approach for that. I hope you liked this video. If you did, please click the like button below, and please consider subscribing to this channel. Thank you very much.